Thanks very much. We've got 30 minutes, 20 minutes and then questions and whatnot. Okay, feel free to interrupt, pose questions and whatnot. It was an interesting story. It was the mining charter, and Gwedi was saying earlier we don't realize how much power we have. That would embody that particular statement. One story, 450 words, 5 days later, 54 billion off the JSE. We sometimes do underestimate our reach, but so mining. What I want to do is just give you this presentation. Actually was for about 45 minutes at a different, in some other venues, so I'll just go through some of the main points, not the whole thing. But why don't you start off with, it's really my perspective. It's the stuff that I think about when I turn my hand to writing about mining. It's a perspective that I want to give you, and it's the risk of mining, which makes the mining sector like no other sector in South Africa. And here are the unique risk factors. Okay, you've obviously seen all of this, a well-known statement. The first thing about the mining sector, our resources are wasting assets. And what that does, and especially when you're covering it as a reporter, is it creates a platform for writing about merger and acquisition activity like no other. So it's not like you're growing cabbages for Pick and Pay, and you're just supplying Pick and Pay with cabbages, and then you plant seed again and you grow the cabbages and so on and so forth. A resource is dying from day one, and mining companies know that that's the case. So there's constant pressure on the mining companies to reinvent themselves all of the time. And they get valued on what's in the ground. And as they deplete the resources, so the value of the company depletes as well. So they're always looking for the next big thing. What this does, that pressure to reinvent themselves, means they often have to step into corporate activity, hence the merger and acquisition activity. And of course, when you get that, you just get all kinds of action. Egos, bump up against each other, and shareholders are never happy. They want a higher offer, and the company is reticent to give it, and you just get real, proper human conflict. And that's just, from a journalist's perspective, it's just fun to write about it. The other risk factor, mining companies are price takers. Well, not in all commodities, and more there's increasingly a spot market developing, for example, in the coal market, but particularly for the precious metals, platinum, and in the gold sector, there is nothing a mining company can do about what it gets for its metal. It's determined on an open market. So in the case of the gold price, now this was from 95 to 99. This was $252 an ounce, if you can believe that. It just sank so precipitously. Back in this year, there were 45 listed gold mining companies, plus minus. 45 separate listed gold mining companies, all producing their own annual reports, they're having their own AGMs. By here, there were about 5 left. That's what depletion of resources and having to be a price taker can do to you as an industry. And of course, soon after that, nadir was struck in 99. By 4 or 5 years later, the price is back up to 500, and now it's triple that. And we've had a bit of an explosion again. So, the Chinese, do you want to talk about the Chinese a bit later, but they came into South Africa and they're paying 3.6 billion rands for a gold asset that was closed in 1955. Again, that's the effect that the market can have. Geological risk, obviously, is massive, the proverbial needle in the haystack. You have to go where the resources are. Obviously you do. But what that does is it creates geopolitical risk. So if I told you that the 3 top gold mining districts in the world at the moment are the DRC, Papua New Guinea, and Mongolia. Risky. It's costly, 11 billion in exploration costs in the last year. And then there's the risk of time. When you build a mining project, it often takes just a long time to build it, to make it happen. So in the case of, there's a mine called South Deep on the West Rand. I'm sure it's taken about 22 years to actually build that mine, and the company that started doesn't exist anymore. What that does is when you're planning a project, what price do you work on? So all kinds of assumptions have to be made about the viability of that mine. and times change, and you can find that by the time you're ready to commission that mine, it's actually not viable anymore. So long lead times is a big issue. The volatile markets we've mentioned, and the payback is far from immediate. It's not as if you're putting up a factory, selling your goods, covering your costs, producing a profit. You've got to sink so much capital into these operations that it can take years and years to pay back. And quite often our mines don't pay back ever. Quite often, whole sectors within the mining industry don't make money after capital expansion has been accounted for. So what this does, this risk, all these elements of risk that play into how mines work, creates a certain kind, or attracts a certain kind of person to run them. And that's where my interest comes into this. Who are these people who are attracted to this industry with so many multiple risks, so much on the line? And the individuals that we have are always huge people. They are always massive egos. That's the kind of animal our industry attracts. And these are the kind of guys that are trying to get into the heads of and try and write about. Some other risks, by the way, it's labor intensive and it's inherently relatively unsafe. Our mines are, is it our gold mines? 66,000 people have been killed since 1900, something of that order. It's just really risky from an operating point of view. You have to get, in the case of one of the Anglo gold mines, 5,500 people from point A to point B, which we traveling to the mine is about, a couple of kilometers. Traveling underground is a couple of kilometers. Traveling laterally to where the rock face is could also be a couple of kilometers. It's, technically very, very difficult to do. And we've mentioned the location of the minerals. It seems capricious, Mongolia, the DRC, geopolitically very high-risk areas, but you have to go where the ore bodies are. Yet. Have a look at this last point here. This is from the Fraser Institute. It's run out of Canada, and they assess, from a geographic point of view, the best polities to invest in and the worst. Who is creating the right environment to attract mining? And South Africa did very badly this year. We were way down, somewhere down with the DRC and Zimbabwe. But right at the end of this survey, the very, very last question, there were pages of things, but the very last question was, how do you rate the importance of mineral potential versus policy factors? And the response was, 60% said, knowing where the minerals are is more important than the actual risk of being there. So the miners have got to go where the resources are, and to some extent that's the saving grace of Southern Africa and South African mining. We just have a lot of the resources. I won't go through all of these, but we know that the mining sector has a very central part in our industry, and actually it's not coincidental. There's a very good reason that whenever there is a major economic or political change, it's the mining industry that gets lined up to fight that fight. That becomes the platform. And what I'm trying to say here is that, shortly after our first democratic elections, and they were writing a green paper of so what part of the economy could actually be changed politically through a charter. It was the mining charter. It was the mining industry. And again, with political lines being redrawn, it is the mines that are being sought out for nationalisation, because I think from a political point of view, the biggest heft, the biggest power, the biggest stage to play on is the mining sector because of its position in our economy. And just to underline the point, this shows you, I'm not sure if you can see that very well, but what it's trying to show is that in terms of minerals we possess from a world perspective, so global market share, we have almost 90% of all PGMs, almost 80% of manganese. Like manganese, who cares about manganese? Well, manganese goes into making steel, so so important for China. Same for vanadium further down, goes into steel, fluorspar, but then of course gold, and very importantly down here coal. We are major players in all of those particular commodities. And so here are the individuals, some of them, like Brian Gilbertson, whose favourite phrase is there's no such thing as a dripping roast in the mining sector. Nothing is easy. Mines are hard to build. So let me give you another example. Anglo Platinum has spent 60 billion rands in the last 10 years and is producing a fraction more than it was producing 10 years ago. So 60 billion. That was all supposed to be for expansion. So 10 years ago, it was producing 2.3 million ounces of platinum, and now it's producing 2.6, something of that order. It was planning to produce 3.5. Mines are actually just hard to build, very difficult to get right. Mick Davis, again, I mean, this is, you talk of big egos. I mean, this guy is a massive interview to do. I mean, just look at the guy. Do not ask a crap question. Just don't do it, because he'll nail you, and the interview can go south very quickly. And of course, Cynthia Carroll, CEO of Anglo American, bit of an iron lady. I think Kevin, what I'll do is how am I doing? About 20 minutes already, I suppose. Huh?
Could be.
Yeah. So what I'll do is, so what I'm getting to is, the thesis I'm trying to build here, that I hope you're following me, is this is a very unique industry. It's a big industry. It carries unique risk factors. It attracts a certain kind of individual. These are powerful people with tremendous scope and often a lot of great vision, but they're extremely strong people, and that's fun to be engaging with those people. So given that platform, given who is in there, it just underlines to me, especially when I'm writing about the mining industry, is that journalism is about entertainment. And it's important to look behind the cash flow statement and the income statement and whatever and say, what are the decisions that went into creating these results? Because they don't generate themselves. It's not some accountant locked away in a room just bashing out numbers. Those numbers that you're seeing are the function of decisions that were made in boardrooms by human beings with all the characteristics that we know human beings have. So their strengths and their frailties and their vulnerabilities and their inabilities and whatever the case is. You've got to bring that in. So when you're writing about the sector, who are these individuals? And I often think that the art of the interview has disappeared. And the art of the interview is to phone up somebody at a company and say, hello, Mr. or Mr. CEO, I would like to do an interview, and you go to the office and you sit there and you ask them questions and get them to answer you. I notice things like body language. Are they a little bit uncomfortable when you ask this? Are they very defensive? Are they aggressive? Because the way they're treating you in that particular interview is probably how they treat their board members and the rest of their employees. So you need to get some kind of insight into the individual that you're dealing with. Okay, I think I won't take it any further than that. But if anyone's happy to discuss nationalisation or questions about any part of this particular presentation, I'm happy to do that.